Hello, everybody. Welcome back to another session. Intense trend following discussions. It's not very intense, is it? Pretty much fun. You can talk about whatever you want to talk about. We got a lot of good things to talk about today, I think, but usually something else pops up that I'm not even thinking about. So let's. Okay, so number one, we had the good interview with Soros. I tweeted that. Go back and just a few days ago, read that quickly. I haven't had a chance to listen to that whole thing, but my friend sent me a small clip of Soros, the part that I tweeted about how basically let your profits run, and if it's open trade profit, that's great, that's free, use it to be bold, and then protect your capital. And so then I had to go out and find the whole thing, the whole interview. Not that hard; it's out there. So I need to listen to more of Soros. Um, he's got some good things to say about trading. And then the second one was Wayne Hemmelstein on his podcast with Mutiny, and that was very good. Jason's incredibly smart. Wayne's one of the smartest. I didn't really understand a great deal about options and the things they were saying, but I did tweet quite a few good things that pertain to our philosophy and strategy that's somewhat similar to Wayne's ideas on option trading. And then finally, another thing to talk about today would be the tweets that Seth put out there yesterday about his research process and what he's come up with using his chosen parameters and system ideas about, and specifically honing in on performance of this year and previous years as well. So anyways, that Seth wants to bring that up or wants me to talk about my complaints about that. Yeah, he DM'd me. I DM'd him and said, well, one of the most sophisticated concepts I came up with was yuck. Yeah, I don't really like some of his choices, but I'm joking. It's really good, and it's a good contribution for trend followers. All right, so let's get going. I'll be quiet. Yeah, that Soros. I'm going to start with Soros. Um, One of the things that's interesting to me about a lot of these bigger than life global macro traders, Jones, Bacon, Druckenmiller, Soros, leaving out a few, is that obviously they're somewhat they'll give you some indications about trend and taking small losses and diversifying and trading futures and currencies. But it doesn't come across to me as much of a systematic approach to the kind of degree that I practice it and a lot of CTAs practice specific strict rules. It's more like maybe seat of the pants or identifying situations and then going with the trend and preserving capital, taking small losses. So I think it's kind of interesting to listen to guys like this. I'm sort of more in the camp of having a set of rules, trading a lot of markets, not cherry picking the markets every now and then for some specific reason, then going with that trend. But anyways, I thought that was pretty interesting. I'm going to read this Soros quote. It's very different when you're risking your principal than when you're risking your profit. That's how you get these big runs. You get it right, and you can risk more and make more money. Risking your profit is much easier. Then he says, the reason we have such a good record is because we never lose our principal. So that's exactly the way I try to design my system, is to have rules that do those exact same things. Take more risk with with an open profit, define my capital, protect it, and try to hit the outliers and make as much as I possibly can, and not be too concerned about my drawdowns in my open trades. So I'm of course, my friend who sent that to me, he said, it sounds like you. And I'm like, yeah, that's why I'm trying to find the whole thing so I can listen to all of it. So I did find it. Yeah, and cutting back. He says, when you have lost, when you're doing poorly, you've got to retrench. Great stuff. Seth, let's hear from you.
Hey, good morning. Um, so I posted that thread yesterday on Twitter, kind of trying to describe how the year had been so far with my model system, and trying to show in ATR terms how the movement has been, and how we had a lot of movement at the beginning of the year, and then kind of some profit give back, uh, I guess, in the third quarter. Um, and I had described my exit methodology, and then you responded to me that you didn't like it, and I thought that was interesting, and I thought you could explain to all of us who are still working on our trend following methodology why a an exit methodology like following a moving average isn't as ideal as maybe just using a breakout.
Oh, yeah. Well, I definitely prefer the breakouts for some reason. It's just, just due to my past. And although also I don't, um, yeah. And one thing about these, I've looked at these moving averages a lot and over the years. And one of the things that kind of bothers me about them is that they can get you in kind of late. I think in COVID 2020, I wouldn't have wanted to trade a moving average uh, because they kind of are slow sometimes. You know, you can find these moving averages and moving average crossovers that are highly correlated to a certain breakout. So, for instance, a 100-day breakout is highly correlated to a 200-day moving average. Okay, so highly correlated. It's not the same thing. And another thing that bothers me is I like to sell the lows and buy the highs. And sometimes the moving average, you don't really do that. You won't, if the market rallies a bit, it may give you a sell signal. And I'm like, ooh, I don't like that. That doesn't make me feel good. Um, and then you threw in this twist, and I asked you about it, and I think I understood it. And that is, it really wasn't even crossing the moving average as far as the exit goes. It was just that the value of the moving average switched. I mean, it went from a high to a low, and on that particular day, you exited it. So I had to think about that one, and I've seen that before in conjunction with the moving average as a final. If the market closes below a moving average and today's value of the moving average is less than yesterday's, then exit. I've seen that before, kind of an add-on feature. But then I guess my biggest complaint was the parameters you chose. They weren't long-term enough. So me, I like more pain and more loose pants, and Moritz came up with loose gloves. Um, so yeah, but that was really only it. I think you'd make a bit more money given your risk and your risk budget per trade if you traded longer term. So that's it. I mean, I think that there is a math thing too amongst math people where they kind of don't really like averages as much as numbers that are not averaged. But that's maybe for someone else, more of a math person to speak about. So, what are your thoughts on that?
Yeah, so I guess what I was trying to do with the exit was, in a really like fundamental basic way, define what the trend is in whatever the time frame is you're using. Ideally, you would use something like this across multiple time frames, so you could capture the trend in different time frames. But the idea was, what actually is the trend? And to me, I guess the simplest form of defining that would just be over the time frame is the trend either up or down, and a moving average is a good proxy for that, but not just the moving average itself, but the direction of the moving average. So I guess what I'm really using is the average of the moving average. And if the moving average is moving up every day, it indicates you would want to be long. If the moving average is moving down, it would indicate you would want to be short. And like you mentioned, I actually do use price in conjunction with that. So I would only exit the market if the moving average has turned down and price is below the moving average. Because you could have one of those situations where the moving average turns down temporarily if you have kind of a sideways market, but if price is still above it, as the bars proceed, if price stays above that average, it's going to pull it back up again. So it's really just me trying to be different, do something different, show something different to show that I'm at least trying a little bit. But you suggested to me that I should try just testing the breakout, which I did, and I emailed that to you. I don't know if you saw it, but you were right. It captures more ATR just using the breakout rather than trying to be fancy and do something different.
Okay, sorry about that. Sorry, misinterpreted. Yeah, I mean but I think the bottom line is just be the longer 126-day moving average. The 200-day moving average will probably be better. I think that's sort of the bottom line, is to move it out more. I mean, you could do the back test and run it in increments of whatever, but it would just pop out to you. So it's not necessarily just a breakout, but I think the biggest issue was just the look back period was not optimal. I just trade the most optimal, and those are over the whole test period, and then so it's super long term, and that's kind of a shame because I have to sit back with a lot of open profit and watch a lot of it melt away. And I think it was a very good thing that you were trying to do. I believe I got it right. Is that just showing performance, and this is what you're seeing with a generic system, and we all, is everyone else, seeing something similar? And of course, it's been a great year, and a lot of it does depend upon your look back. And I'm not out of the woods yet because I could continue to underperform relatively because I am so long term that I could still give back a lot of profit. I'm still long quite a few grains and short all of my interest rates and short all the currencies. So I haven't gotten out of anything. I have gotten out of some grains though. But another thing I thought was very interesting was your choice to show the profit give back, which I don't think you meant it to be some sort of risk measurement, but I'm interested in hearing your thoughts on that column of the profit give back. And of course, my response I think it's fine. I have that on my report, my daily reports too. Yeah, I do. So my programmer has given me all of these things to look at, and that is my max profit, my current profit, my max drawdown in the trade, current drawdown, all sorts of things like that. But I don't think I think it's just something trivial to look at. It doesn't mean anything to me. I don't think optimizing your look back or your strategy to avoid that, to make that number less or work that into somehow your performance numbers is worth doing. I think it's strictly just total profit, given that you're risking 50 bips with a 3 ATR. That's my risk metric. I'm risking 50 bips with 3 ATR stop. Which parameters are going to yield the most profit when I'm keeping my losses really small like that? Okay. What do you think, Seth?
So the reason I did it, kind of in the way I started the thread, talking about how percentage returns aren't necessarily a fair judgment because you have, leverage to consider. I guess the biggest misunderstanding I had when I got into trend following was how lumpy it can be. I think some of the books that are out there that have been written by people who don't necessarily trade for a living kind of overstate the magnitude of potential gains, but don't necessarily talk enough about the potential losses, whether that be of original capital or profit, open profit. So I wanted to just kind of using ATR in a way that's a little bit more understanding. And if you look at it, actually, I didn't include it, but in my column on my own sheet, I actually have like the percentage of profit give back. And I think around the average is something like 40% of, the highest profit earned is given back on any given trade. So just as a way to be honest with myself and honest with kind of what I'm putting on my website and stuff like that, I just want to give everybody the clearest picture about what it's really like, I guess.
Hi to everyone. We faced some program issues today, but now it all looks okay. I want to say that I have heard some interesting thoughts from Seth, and I think yes, there are some books that some authors that not focusing maybe on drawdowns. And I think that it's an example of a bad marketing thing. So a person thinks about marketing, thinks about to be attractive to the people, tell people what they want to hear, and so they will buy his books, pay him maybe for learning courses, etc. Yes, but trading, and I want to say that business processes in general are not organized, are not designed in a such way that we have only profit, we do less, we don't learn a lot. It's not, and I think most of us here know this. So of course, we must, if we want to be involved in a process, we must understand all the general components of the process.
Hello, everyone. The month is going negative for me as a short-term trend follower as well. And so this week I spent a lot of time numbering the markets that I trade. So I trade more than 60 markets. So instead of giving them names like soybeans and the cocoa and all other commodities and all other diversified markets that we usually trade, I decided to give them names from 1 to 60 plus. So actually, I'm trying to disassociate it. I try to disassociate myself from the underlying market name. So this is the exercise that I've done this week. I'm not quite sure it's going to be worthwhile, but it is. Everyone else is talking too much about the inflation game and the recession and whatnot, and I'm trying to, as a trend follower, I'm trying to keep my focus on the numbers game and trying to look into the statistics, so to speak. So that's something else that I just wanted to mention. I'm not quite sure whether anyone else has actually go to the lengths of putting numbers into their markets. And the second thing is, I was, as you have mentioned, I was just thinking about these drawdowns, the average drawdowns, the drawdown line lengths, the depth, the average recovery times, and the maximum drawdown. So we all, look into these, statistics in terms of the trend systems. But I wonder whether is there any number, that so if a system is good, so you want to model, let's say 20% drawdown number. Okay, but if you actually go ahead and model 30% maximum drawdown number, you're going to go, of course, you're going to possibly going to make more money, but you want to keep it less drawdown. But so is this just a choice? And it seems that if you're a new trader like myself, I try to keep the modeled drawdowns not exceeding more than 20%. But it's always a question on the mind, really. Why not model a little bit higher if it is just a personal taste, and if you're not managing any money, if you're not a money manager, but if you're a solo trader, so why not? So I mean, this week I was very busy with that, so I just wanted to give you just a peek of what I have done during the week. Thank you.
I know there were some comments about using, this is a little bit off the subject, but my thoughts on measuring the profit and loss with using the ATR at entry. I like to do that because I think using the ATR, how many ATRs did a trade make, and putting your statistics, your trade stats in ATR terms is a pretty good idea. It's one I've used my entire life, but it's just a good measuring, way to measure, and it eliminates some of the contamination that you'll get from evaluating your results using percentage terms, because it's this random nature of how your trade level, your AUM at the time, will influence the trades results. And so you could have two trades that made 50 ATRs, but have a different percentage profit. And so I think it's just a purer way to look at the research and see exactly how is this system performing? How are these trades? What is the difference between System 1 and System 2's trades? In my opinion, it's just a better way. I think I don't have a good thought on this, so I don't want to dig deep into this because this is going to make me sound like I'm less than smart. But I really listen to people talk so often about percentages, and I just shake my head because I just think sometimes using percentages to measure things just gives you a really bad perception of what's really going on. I can't think of a good example now, but anyways, I like using the ATR. But
I have a quick question, Jerry. You mentioned that you don't like the percentages, but if you just compare a short-term trend follower to medium-term trend follower to a long-term trend follower, we use vastly different ATRs. So if I say that my maximum drawdown is X number of ATRs, or if I start talking about ATR terms, would that be comparable to someone else who's actually doing running a one-to-one same system but on another time frame? I just thought that maybe percentages would be a better, more meaningful. No?
Yeah, I agree with what you're saying. So that's why I was trying to be careful and say, if I'm looking at System 1 and System 2 and they're both long-term trend following, I think that's okay to look at ATR. But if I'm trying to compare my long-term to your short-term, I don't think it's going to hold up. I need more information. I need to see it in the context of how many trades you do, your average holding period, your average win, your average loss. And I still probably want to evaluate your choices of which short-term parameters you're using in terms of ATR, but I think it would be difficult for it to be apples to apples to compare long-term and short-term in those ways. But it really, I think you have to be very comfortable with it. And I just live in a world that is medium to long-term, and I've done it for 40 years this way, and it's fine. And I've just extolled the virtues of it. And if it doesn't resonate, then forget it. But I was just sort of saying, I know that there was some pushback on, why are you using ATR? Well, that's why, because it eliminates, and whatever you need to, I think, however you do it. And another thing too is, like, if you're trading really short term, it's probably not, this AUM and trade level is probably not a big deal because you're turning these trades over so quickly. I'm holding a trade for a year, and I just made 35% in that year, and I haven't changed my trade level for the trade I put on a year ago. So I have some issues there I need to work through. So that's it. It's a much different game.
Actually, yeah, it's not that different, actually. Everything else is the same, isn't it? So for instance, what I do is just I'm using hourly data set. And, let's say that a long-term trend follower is using 200 days to 100 days. So I'm using 200 bars to 100 bars. So it's one entry, one exit, one stop. Everything else works the same way. So what is the real difference really is, yes, your average hold period is going to be different. And for instance, if a long-term trend follower is going to be holding the same trade for 1 year, so a short-term trend follower will be exiting and entering it many times on the same trade. But I'm not quite sure whether the risk-adjusted returns are going to be significantly different because you will be making money, let's say, during the geopolitical event like this year, or when the inflation trade happens, or when there's a geopolitical or a recession event. So that is that. But in terms of the levels, it's just about using the computers. You see, I don't think that it actually necessarily, is a difference. Which level to trade. It's just, for me, it's computer does it anyhow. So I do have a predefined definition of equity. So that equity is being traded automatically by the computer. I do not have any human intervention to that anyhow. So I don't think that necessarily that part changes between a short term or a medium term or a long term trend system. No. Thank you.
G'day everyone. Can you hear me?
Yes, sir.
Sorry, everybody. I had big audio problems coming on, but I've sort of caught up to where we are, and it's a great discussion. And look, one of the things that I personally prefer is using ATR or R for my trades. And the reason I do that is that I think it's very important to have a measure that always evaluates your losses against your wins. In other words, we want to eliminate impacts of time. So, for instance, if you're using percentage measures, you tend to think, for example, that all of the profits that we've generated in the first half of this year was generated from the first half of this year. That's incorrect. We've been on these trends for the last 3 years, 2 to 3 years, and the trends have amplified and our positions have got bigger over the course of time. So when you look at it from a relative perspective of the trade statistics, and you're looking at the relative performance of your losses against your wins, that is a much better method that really means something in our trend following landscape. So when you're using percentage returns, that sort of tends to sort of focus your efforts towards the profits. You therefore sort of don't necessarily sort of taking notice of the asymmetry in your returns. I think probably the most important information we can get out from our trend following space is the distribution that our systems produce. And we're looking for this asymmetry in our distributions, the relationship between our losses and our wins. And therefore, I much prefer using relationships such as ATR, or R. I actually really do like R, which was developed by Van Tarp, because you're looking at the non-linearity that exists in your distribution, whether it's got positive skew, whether it's got these features that we want. And that therefore helps us to focus on what our game is all about, this asymmetry we're trying to produce with our distribution. So that's my 2 cents. And also in relation to the issue of drawdowns, I much prefer using the ratio of MAR, which is relating the overall compounded performance against the drawdown. So I'm less concerned with CAGR and I'm less concerned with the drawdown, but I am concerned with MAR, the relationship between those two. So it's trying to divorce the focus towards a particular aspect, such as just our losses or just our wins, and looking at the combination of the two and how they relate to each other.
Hello, Richard. I think this is very helpful. Just 2 quick points. First of all, yes, I do use, and I like the R multiples as well. And and there's one aspect to it. So we actually determine the expected value of a trading system, then multiply it with the number of opportunities, which is the number of trades. And those number of opportunities are going to be much higher on a short-term system, and the R going to be smaller, and on a long-term system, you're going to have higher R numbers, but the lower number of opportunities. So, with the same risk parameters, I don't think that the where you're going to end up is going to be significantly different, but it is possible to find some correlation benefits by incorporating short and the long-term systems, I believe. So just I wanted to mention that aspect. The second point around the drawdowns is, you mentioned you wanted to look into the market, and that's how I have conditioned as well. But my only concern is whether am I giving too much importance to the drawdowns? Everyone talks about drawdowns, and it is the biggest worry about the trader. Everyone says that your biggest drawdown is the one that you haven't had. But is this the we need to be concerned about drawdown? There is no doubt about that. But is the wider society, I wonder, are we conditioned to be worried about those drawdown numbers more than we have to? So this is the question on my mind, actually. Thank you.
Yes, look, I agree. I think when it comes to drawdowns, I think there is such a big difference between trading a personal account versus an investor's desires. So investors always want the smoothest return. And this is the problem that Jerry and I have always been talking about for such a long period of time. There's the business of trend following, and then there's trend following itself. And trend following itself, I think, needs to embrace this volatility, but investors can't. So inevitably, managers are compromising the principles of trend following to give this smoothness. So when I'm looking at drawdown, I'm always relating it to the upside potential versus my drawdown, because I believe that this asymmetry, having this open-ended profit potential, is the most important side of our business that really sets a trend follower apart from the competition. Any sort of adjustment of that to smooth things or to reduce the pain of the drawdown, to me, is a measure that is effectively, in the long term, it's possibly warehousing risk. In other words, it's adding an additional layer of hidden risk into your portfolio that you won't be aware is happening until it's too late to fix. And that's where suddenly your drawdown becomes crippling. So I think we've got to accept the volatility. We've got to accept the drawdown exists. And that's why my relationship, to me, is perhaps the most effective measure of all, that keeps me sane and keeps me sort of not looking at how much dollars I've lost or how much percentage I've lost. I'm looking at the relationship between the two, comparing that with my back test, seeing if it is within tolerable bounds for what I'm seeking, and that's how I view it anyway.
And I think that when we follow our core principles, our core trend following principles in particular, we have such a system where, of course, as we always say, the drawdown is a necessary part of a system, and we will have no profit, of course, but without a drawdown, so we will have no systematic trading at all. But drawdown also, in philosophical maybe sense, drawdown protect us from ruining our capital. Because if our system is designed in a good way, and we all know, not all I think, but Jerry said that, and Moritz said, and Nils, that drawdown must be in trend following system must be twice more than average year performance. And as I understood this, that of course it can be maybe one time, it may be one time in 10 years theoretically, but sooner or later you will see the drawdown. If you trade in a good proper way, you will see a drawdown that is too much higher than your average return. So If we trade if our trading system based on a good rules, it's okay to have a drawdown, of course. But first of all, we must focus on the rules, on our philosophy on the rules, on risk management, I think so. And not, of course, not avoiding the drawdowns. I thought about this a lot and about different, a few years ago, maybe 5-6 years ago, about different filterings and to get drawdown more smoother this process. But I think first of all we must think about focus about our core principles.
Really mean that 2-to-1 MAR ratio is always better than 1-to-1 MAR ratio of a system. Because if our philosophy is to cut the losses short and let the profits run, and if this means that using asymmetry, and if this means that we are hunting outliers down, so this is something else happening. And on the other hand, if we actually try to optimize the MAR, I mean, are those always consistent among themselves, or
over the long-term track record they are? So if you took the MAR ratio of the trend followers over the last 3 years, they're going to be around 1. If you take the MAR ratio of the trend followers over the last 20 to 30 years, it's going to be about 0.5. Now, the difference there is that there are no alternative strategies that have been operating. There's a buy and hold, of course. There's Buffett, of course. And these alternative strategies have much lower MAR ratios over 30 years. So they're regime dependent. But the longer the track record, the better your MAR ratio is representative of a wider array of different possible regimes. So you've always got to look at the very long-term track record to get a reasonable basis for what your MAR ratio should be, and not sort of get into the situation where you believe that because your MAR ratio is sitting at 1.2 currently, that you're not going to experience, a far lower ratio in the future. It's exactly like the principle of a drawdown. Your worst drawdown is always going to be ahead of you because history has only presented a very narrow data sample of what is possible. And if you go back over thousands or hundreds of years, 200 years, 300 years, this is what Wayne Himmelson was talking about, you'll see that the possibilities are far greater, or the distribution is far greater than the small sample distribution we've got to work with the last 20, 30 years of history.
Seems that a lot of people are having trouble with this app today. So I don't think I think it's Twitter's problem. Anyways, I don't really agree with too much of what I'm hearing here, but I'm going to just go back very quickly. I wrote it all down. I really don't, I wouldn't really pay too much of attention to MAR, and I'm not going to pay hardly any attention to my drawdown, or I'm not going to sort of care too much about how it looks in comparing to the back test. But I'm going to say to myself, where am I drawing down from? If I'm going to draw down from this peak equity, is it the peak equity that I'm having a drawdown? I'm certainly not going to care too much about that. I'm setting up my trade level to be close to my closed trade equity, which is a lot lower number than the current equity. So, and I'm going to defend that lower number. If I have a drawdown from my closed trade equity, my trade level, then I'm going to get very nervous. But I cannot defend that max equity number and plan on being able to continue to do all the trades that I'm supposed to do. And I cannot let my profits run. This is the reason that when the CTA managed futures industry does vol targeting and correlation, vol management, correlation management, they do it in order because they are defending their all-time highs. We cannot have a drawdown we've identified a number that's tolerable, and we need to do things before this happens, which is reduce these positions in the markets that are getting very volatile. So, but this does not allow them to do all the system trades they have these other trades, risk management, money management, fall management, correlation management, and they really want to sweat these open trade equity drawdowns because, as Rich said, it's about the clients and keeping the AUM and the management fees, where I say sweat the closed trade equity drawdowns, but you're not going to have them really. And the closed trade equity drawdowns are always less than the open trade equity. So to some degree, you don't even have a drawdown in your closed trade equity. But taking these small losses, and with the system it has 40% winning trades, 60% losing trades, these losses can build up if you're trading really large with high leverage. And so you do need to defend that open trade equity. That closed trade equity. We can come back from big drawdowns if we implement these type of strategies. We can have a 20% drawdown every year and make 20% every year. And this is the very definition of bumpy and lumpy. It's not going to impact our performance. These drawdowns are not going to impact our stated objective of how much we want to make per year. Is it 10%? Is it 20%? Is it 40%? The bigger you trade, you're going to have these bigger wins and you're going to have the bigger drawdowns. And so I'm going to sacrifice everything. I'm going to trade a certain leverage. I have a certain trade level calculation, a certain ATR stop losses that allow me to do all of the trades that I need to do. I'm not going to have a maximum heat or maximum risk. I set my maximum risk on the first day I started trading. I set it at a level so I could do all of the trades. So I could be 100% disciplined. I will cut back if all hell breaks loose and every position I have on is getting crushed and I'm in this massive drawdown. Think February 2020. I will reduce my positions and my leverage for a while, which would allow me to continue to do the trades. So there's nothing more important in all of trading than doing the system trades. Those trades at Seth, buy the 126-day high, liquidate at the 126-day moving average. That's the bottom line. Nothing is more important than that. Do whatever you can. Trade small, fiddle with your trade level. Once a year, once every 3 or 4 years, do the max cutback so you can go right, do the cutback so you can go right back to doing those trades. I'm not going to let anyone's, including my own, fear of volatility and drawdown impact the fundamental principle of trend following and systematic trading, which is do the trades.
I like this much, and I want to add that I like what Neil said a few times, that first and foremost, we are risk management, so we can't control the upper side, but can control downside. So we can control our risk, and we work with risk, and I like this.
I don't think that asymmetry is impacted by drawdowns because it's the asymmetry of the trades, not the rate of return. And I don't think that as long as the trades look similar to the back test, where the average profit is 3 or 4 ATRs, the average win, I don't remember what my average win is or my average loss, I know is 4 or 5 ATRs. As long as these trade stats are similar to the past, these drawdowns are not going to impact the asymmetry if you look at them on a trade basis, on an ATR trade basis.
Yeah, I agree with that, Jerry. But this asymmetry that we're talking about is fairly unique to divergent systems. So for trend following models, this asymmetry is imperative because alternative models, they lack this asymmetry. So when they get into drawdowns, they take a very, very long time to reach a new high watermark. And that creates this compounding drag, which we're all familiar with. But with our asymmetric trend following models, we can tolerate far higher drawdowns because we're back up to a new high watermark far quicker than alternative methods. And that's because we've got this positive skew, we've got these potentially unlimited wins against very small losses. So when you get into that regime that's favourable, bang, you're straight up to a favourable high watermark. So the impact on the compounding effect is much less than what alternative methods are that don't have that positive symmetry in their trades. And whether it's looking at it at a trade by trade level, you can also see it at the KGAR to drawdown level, this asymmetry. The asymmetry is in both KGAR versus drawdown, and it's also at the trade by trade level. What's the smallest win, or what's the average loss? What's the average win? What's the greatest win? What's the greatest loss? What's the highest KGAR versus what's the maximum drawdown? You see the asymmetry in all of those statistics. So, you know, I see they're all valuable to a degree because it's telling us that our particular method is asymmetrically orientated. It has a capability of taking full advantage of outliers when they exist in a market condition, and that's what we're hunting.
I like this idea that we see asymmetry everywhere in the market, and I think that maybe it's not a quite similar topic, but I see also non-linearity. So when I look at the chart, I see non-linearity, like Richard said, or always talking about this very often, that when I personally look at the chart, I see a periods of flat, I see periods of trending periods. So when we are in trending periods, we have profit. In flat periods, we have losses. So, like Richard said, and I remember this: +1, -1, +1, -2, +2, -3, +20. That's one of the most important things in trend following that I have heard.
I wanted to get back to Seth and others to comment on what started this, which was him showing the give back and what his thought process was. Is this something that would influence people to choose different look back periods, irrespective of the computer saying, well, if you're going to risk 50 basis points and 3 ATRs, then keeping that constant, these are the parameters that I choose to make the most amount of money. That was sort of the issue, well, one of the issues I would have with kind of Rob's research on fall management was that's not where he started. Like, let's start there, run that system, and then now let's use that same 3 ATR, 50 basis points, and add vol management. That's how I would have done it, right? And I would come to the conclusion that I'm not going to use vol management. But anyways, I wanted to get, that was just a plug for not MAR, not Sharp, not Drawdown, but my risk budget is 50 markets, 50 basis points, 3 ATRs. How much do I make if that's a given? And so using the computer to tell me which range of parameters maximizes my profit. However, I'm interested in my question, which is, that's really good, Jerry, but I would try to choose shorter term stuff and maybe sacrifice KGAR a bit because I just don't like giving back so much profit. So can you speak to that, Seth, and others?
Yeah, I just, the only reason I had the give back on there was just to be aware of it. I think it's worth knowing what to expect, that you're going to give back a good bit of your profit in trend following, and just having a measure of that just makes me feel a little bit better, I guess. But to answer your question, no, I'm going to optimize for ATR capture irregardless of the give back, because I mean that at the end of the day, you optimize for profit capture, and then you can leverage it to whatever leverage level makes you most comfortable. And my 126-day breakout that I'm using, that time frame isn't optimized. That I just picked that as an example because I think it's understandable for a lot of people, and I think a lot of people would consider 126 days to be pretty long term. I don't necessarily think that's long term, and I know you definitely don't think that's long term. But I think for it just to be relatable to people who don't have a great grasp of how trend following works, it's a good starting point.
Yeah, I agree with all of that. And it's not so much that I don't really feel comfortable usually labeling things medium term, long term, short term, because it's really just subjective. And so that's when people ask me, like, are you long term or medium term? I always say things like, well, my average holding period's a year. And my look back is 125 days minimum. And so you tell me, as relates to other managers. And so I think it's absurd the amount of give back that you have to in trend following, especially if you trade these systems that in the way that I just described, and then the computer keeps saying, no, go longer term. And you're like, what the hell? Yeah, I think it's horrible. And but some of these gains in that maximum gain column, or even in your ATR profit column, you would not have had those if that size gains, obviously, if you hadn't at some point in time allowed the market to have a big give back, because the big give backs may not come. They may come halfway up on the trend. So this big give back we've had in some of these grains, if they all go back to the highs and make another 50 or 100 ATR, there you have it. That's why the computer says, hey, this happens. It doesn't happen often. And 10 trades, you may make less money on 10 trades. It's that 11th trade that makes another 200 ATR that paid for all of those mishandled, quote unquote, other open profits, and then you made it all back. And so it's just all in that back test. That's where it all is. And the back test is like, yeah, go through me if you want to. You can look at all the trades and all the pain and all the suffering and think you can handle it. But I'm telling you, if you look at all the data, you will have these tremendous rallies after you suffer a material drawdown and you make profit that you would not have made. By definition, that's how it's working. So it's a bummer that is the parameters that we need to utilize.
It's very interesting, Jerry, because you've got your method of effectively optimizing based on what you're seeking out of your trend following models, your 3 ATR, your small bet size, etc. But I'm doing a similar thing with a workflow process that's using the data to tell me what I should select. And I'm getting exactly what you're getting. And the reason is, so if I just explain this, if, for instance, I did a back test of a trend following model on a single market, and I had a 30-year data history of that single market, the model is naturally going to fit to that data. So it's going to fit to the data presented to it to give an outcome. And the optimization selection might be, well, for this particular market, choose 2 ATR. For this particular market, choose, a trailing stop of this, etc. However, when you then apply that same model across 55, 60, 70 markets, what you're doing is you're not fitting to a single market, you're fitting to all markets. In other words, you're creating a universal principle, a universal sequence of parameter values for those very simple systems you deploy, which are applicable to any market. That, therefore, is significantly increasing our sample size and our confidence in our process. And when I do that, I find that if I was fitting to an individual market, I'd get a whole different array of different stops, different trailing stops, etc. But when I pass it across all of the markets, lo and behold, I'm getting ranges of 3 ATR to 5 ATR. I'm getting all of the things you're talking about, but that is through a process that I believe has sample size, as you talk about, and it's basically validating the premise that a trend follower is not going for the specific characteristics of an individual market. It's targeting these outliers that are anomalies in a market data series, but because it's diversified across a vast array of different markets, it's naturally falling on these parameter values for robustness reasons, because those particular parameter sets that are applicable to a market, a single market, when you apply them to another market that has a totally different character, they totally fail. But because the workflow process is across the entire set of markets, it's a universal parameter set that is applicable to a vast array of different possible histories presented by that market. And that's more like how we should view going into the future. We don't know what the future is going to be. It could be a vast array of any different possibility, and therefore this robustness principle that we have in our method that allows us to determine the most robust settings is not based on profit, it's not based on loss, it's based on survival, which is represented through this robustness testing we're doing through our workflow process.
I like this idea very much, and I like that. First of all, when we apply universal rules for different markets, we can have a lot of sample size, and I like it for many years, maybe 6-7 years ago. I began to think about that. And the other thing that I have more confidence and to follow my system, because I see that the same rules, the same things work in the same in the different markets, in the different environments, maybe even. If we are talking about long-term period, especially. So when I say this, it builds a confidence and a faith in the system also.
Yeah, that's really good stuff, Richard. I loved all of that. It's kind of funny because unlike most traders and most managed futures CTAs, I'm not concerned about this crude trade at all. I'm not caring about this drawdown at all. I'm just going to continue to religiously apply my rules, and I'll get out when at 70, 80, whatever, 90, 150. I don't know. And my exit rule is not what has been historically best for crude. This is outrageous. So you're not even looking at what's best for crude. You're looking at this crude exit may be heavily influenced by currencies, or obviously it's going to be heavily influenced more so by currencies and interest rates and stocks than the crude market, because whatever worked best on those three is probably what my parameters are. I don't know. I've never looked into it. I've never optimized per market or per sector, but it's probably some funny things in there. And this is right back to the root issue that is so important, which is sample size. And you can't get the sample size unless you pretend that all the markets are the same. You're going to trade them all the same with the parameters that work best on the group, 100, 200, 300 markets. Longs and shorts as well. Well, shorts don't act like longs. I know. And we're treating the outliers, the 5%, and we're saying, like, don't pay attention to that was an outlier. Just grab those trades as long as all the small losses together. And what happens when you apply all those parameters? Oh, yeah, we do get some outliers. They do drive all the profit. So it's really a funny little scheme we have that is so counterintuitive to almost everyone else.
Exactly, Jerry. And what we're doing, we trade a portfolio. We don't trade an individual market. So what we're doing is we're removing selection bias, we're removing hindsight bias, like which markets to trade, through this process, because we're treating them all the same. And I think that's a very safe way, much more robust way to do it. But more importantly, what it means is that there is no individual stream in our portfolio that can bring the whole thing down. They're all developed through the same processes. The solutions you develop are applicable to all markets. So you've tested that over a 30, 50-year period or whatever, and you've found that there is no single return stream over that back test which has compromised the entire portfolio result. That's robustness. That just tells us that out of what history has presented, we've got the most robust solution. We don't know what the future is going to present, but we know from what history has presented, this is robust. That's as much as we can say. No future prediction or whatever. We just have a robust portfolio we take into a live environment for the future and just continue to undertake our processes.
And I want to say here that if I would see some maybe individual stuff that works on a particular market, for example, on a grain or a wheat or something like that, and of course it would be reason on that because this stuff works, so this maybe type of stop loss and so on and so forth, but I don't feel that I can trust the things, because when I have general, as I always say the same, that it's like I see that the nature designed in the same way. We have periods maybe of rains, we have periods when we have no rains and so on. So it's an example, just an example. So if I see something that looks individual, something that looks maybe unique, I don't feel that it's a good idea to trust this, and at least we must have a very, very big sample size, a very, very big data, and understanding the reason of this. And the second question, as I always say, do I need this to implement, to apply to my strategy? Will it be done? Will my strategy better? Will be my strategy better after this, or it will only add a complexity? And all my research shows that it only adds a complexity in the very best situation.
Hi everyone. First of all, thanks for being here. Jerry, I think we have some audio issue. I couldn't get to hear anything until I got here in the panel. But anyway, on this topic that you guys are talking about, I'm not sure if I've missed any of the starting points, but I would like to add, perhaps risking repeating anything. I wouldn't employ a strategy of identifying the parameters I want to use, like Richard first described, that look at what's the optimal system for one market and compare for a different optimal system for a different market. And if you do that, just like Richard said, you will end up finding out that you don't have an optimal system. But I would say that all is not lost. When you do employ a range of systems for all markets and compare what's the return distribution of the distribution of trade returns, you'll find out that the distributions look awfully similar. And that's, for me, that's the main signal of robustness of trend following. And what it does encourage me to do is, when I do have this distribution of trades that's similar for different markets, I can be comfortable in applying the system for a new market that I have no history whatsoever. So suppose a new stock come in, and I want to trade that stock because it should be different from anything else. I don't know. Suppose it's a new company that trades whatever commodity, you don't even have a futures market for it, and you want to have some exposure for that sector. But first, you don't feel comfortable if you can employ your system because that price don't have history enough. Well, what I say is you can feel comfortable about it because trend following systems are so robust that, and the history shows that. And how does it show? It shows that when you, just repeating myself here, if you're applying your system, your range of systems to different markets, you'll see that they behave similarly. They have that positive asymmetry. They have that negative median return, positive average return, a low hit rate. They behave in a similar fashion, and they do behave in a similar fashion for different markets. So what's a new market coming in? It's just one of those, one more market that you can comfortably apply your system on.
Great point, Bruno. And really, a new market is just an alternate history. And we might have a very limited history, but if it's worked on, 100 of our other markets, you can be confident that applying that trend following system or that ensemble of systems to that new market, it's robust.
And I was listening to a podcast the other day where someone was talking about backtesting CTAs, trend following backtesting, and they were trying to make this point that when what happens with how do you adjust your models when you see COVID and those market moves, and then at some point in time when the COVID data falls off, I mean that was their choice. I use all the data, but let's say then that data falls off, then how do you adjust your models? And so there's my point. I don't look at equity stats. I don't look at how the markets, the theoretical equity curve of my backtest. Oh, I look at it. Come on. I mean, I look at it, but that's why I'm just, it's only safe to pay attention to this trade stats, average win, average loss, average trade, win-loss percentage, win-loss ratio, winning percentage, and things like that. Because they're not going to be as impacted by crazy periods. They're going to not move the dial very much, positively or negatively. My average trade will go from 3.1 or back to 2.9 ATRs. Okay, so it's dangerous, but this is what managed futures do. They're only looking at those rates of return historically and into the future and present day, in these drawdowns. And it's all about the trade, not the period return. What is the healthiness of this trade? And that's why it's very helpful to look at trade stats in terms of ATR.
Yeah, the answer for that question, what do you do about COVID? I would answer it with another question that I learned from you, Jerry, and I carry it as a badge. What's the sample size? How many COVID events did you observe? And how many do you expect to observe coming next? With what confidence can you say that something changed? You simply can't. You have no sample size.
Yeah, I mean, I'm shocked when I listen to podcasts and read articles that the quants and the math people seldom say anything about sample size. It takes someone like me who knows very little about some of those topics. I'm an expert on trend following, and that's pretty much where it stops. And I have other people to advise me mathematically and write code and do back testing. And I observe and I remember and I learn, especially I learn things not to do, things not to believe in, but it is a lone voice continuing. I mean, the only thing I say more than vol targeting, vol management is evil is sample size is where it all begins and ends. I would love to relax that, and by someone telling me that that's not necessarily necessary, but I'm still waiting.
Well, the benefit you've had, Jerry, is you've got 30 years of experience. That's your sample size. And Dennis put a very good tweet up this week about, should he get into Python and all of these different methods of coding methods, because it appears to him at least that investing a lot of time in all of this coding is taking his sort of focus away from the main game of trading and more into the coding world. And I tend to think that a lot of quants particularly do start getting very attached to their tools. In other words, we've got these fantastic tools now available in computer world, which it really encourages quants, I think, to focus on what I call regime dependence. In other words, how can I squeeze a bit of extra profit through this big data analysis of this data set, to squeeze everything I can by fitting my models to that data set, which is fitting their models to an explicit regime. And I think that's where you've got to keep the philosophy as your center game, as opposed to the tools you use, because otherwise you lose sight of what trend following is about. You start looking at smoothness. You start looking at how do I massage the volatility. You've got this market data of 30 to 40 years that tells you that the market data has almost a Cauchy distribution to it, and yet you kid yourself using these tools in a small sample landscape over a particular regime that you can squeeze extra profit out of that regime. But really, you're just falling into the trap of timing. It becomes a problem of timing with your models, which is what trend following is all about. An alternative method that doesn't use timing. It's robust across multiple different regimes. It's a proven track record. Experience means everything. Sharp means nothing, etc., etc. All the things we've been talking about. And I think it's this technology and people's sort of skills in statistics, which is forcing them towards thinking that they can outclass what the market delivers. And I think that's a mistake.
These back tests, you can become quite intoxicated by the back test. I have been there and done that. And the people doing the back test, they're so into the back test. I mean, that's their job. And you need to have a counterbalance. And I would go into these meetings, over the past 39 years or 35 since 1988. And we would talk about, and my whole job was to just be philosophical. And repeat at every meeting, this is what we believe. Philosophically, this is what we believe. All the stuff that you've heard me say. So nothing, I'm not leaving out anything. Just not going to repeat it all right now. So, and then that would set the tone of this meeting. Let's humble ourselves. This is just the back test. This is just what we've seen historically. The world is going to be much harder and more difficult. And if it's not, hey, great, that's great. But let's plan on, and then we would come up with this category. What are some of the things we refuse to do? We refuse to add to our strategy that the back test is agnostic or says, oh, no, that'd be totally fine. You can do that and get away with it. And then all of a sudden, 2008 popped up and you're like, ooh, we didn't get away with it. Yeah, we were wrong. You can't do certain things, even though because 30, 40 years back test on some of these things is not enough. It's like building a building and the engineer saying, well, let's just look at the past 50 years here in Florida, and what's the biggest hurricane we've seen? Well, let's just build it a bit better for that. And, that's not the way to do it. That is not the way to do it.
Yeah, if the goal is to improve the backtest, one way to do it is to reduce your sample size. Reduce it to 2 trades. You have fantastic 2 trades and a fantastic backtest. What does it tell you about the future?
I want to comment a little bit on another thing I think you were saying, Bruno, and that is that I've said this many times before, but I wanted to repeat it. And that is, when I look at a broad set of parameters on my systems, I have systems 1 through 4. and the look back is different. 1 is shorter term, 4 is longer term, and then I have 2 in between. They all make the same amount of money, risking, my 20 basis points and my ATR stop loss over the test period. They make the same amount of money, and that's pretty darn nice. Does anybody want to just Rich? Oh, I know one thing that you said this week, Rich, I thought was pretty interesting. And it was something about dark thoughts, I think around asymmetry. That was pretty interesting if you want to pick up that.
Yeah, so what that was, Jerry, was it was after reading that Soros article. And, you might have guessed that I'm getting a bit annoyed by this split camp in trend following, and I'm tending to think to myself, well, maybe the problem is us calling ourselves classic trend followers, and maybe we should consider ourselves as something totally different. We've sort of been trying to do that with saying we're hunting for outliers, which is sort of setting us apart from the balance of trend followers, because our method is different to what a lot of people classed in that grouping of trend followers or CTAs or whatever are doing. And I was thinking to myself, well, how different are we to Soros? Well, really, we're not different at all towards his main game. And it's a bit like saying, if you want to travel to Mars, a rocket is simply one way to get to Mars. If you think in terms of the rocket, and so if we think in terms of the system, that's only one way to achieve an asymmetrical outcome. Soros achieves a very similar underlying philosophy to what we do. He preserves his capital. That was the key thing out of Soros's method. He said, preserve your capital at all costs, but be prepared to take the punt with your profits. And that's exactly what we're saying. So realized balance is the most important thing we've got to protect at all costs. But once we've placed that bet, we do not adjust or tamper with that the unrealized equity lying in that trade, because that's our bet. And it doesn't matter how big it gets. That means that we are leveraging ourselves into that bet, but we're preserving our capital at the same time. And that's exactly how Soros made his money. It's also exactly how Buffett has made his money. And that's where really, people talk about, what are the similarities between the great traders of the world? And it often comes to a psychological reason or whatever, but fundamentally it all comes down to this notion of asymmetry. And we achieve this asymmetry through that great quote by Ricardo, which is cut losses short and let profits run. Our method of achieving that asymmetry is perhaps the simplest method of all alternative methods of asymmetry. It's proven. It's incredibly, I'm wedded to it. You're wedded to it. All of us here are wedded to it. It's just sort of like what I call a lay down misère. It really is the only way to go.
But wait a minute, Richard. There is one fundamental thing that would differ from the Soros approach. Well, I'm not a student of Soros approach, so I may be. I'll be glad if anyone could correct me here if I'm wrong. But I believe that he didn't kept his bets small, and he didn't diversify that much. Perhaps there is a luck factor here that for regarding the period he lived. Perhaps the period he lived could support making larger bets, but I don't believe that one thing that is core to us, that is small bets and diversification, played a role in his mindset. But on the let your profits run and cut your losses, he's completely 100%, I believe.
Great point.
Well, he goes on in that interview with Charlie Rose. He goes on to say, well, he tries to educate Charlie Rose, but Charlie keeps, I don't know, saying dumb things. He doesn't understand what he's saying, and he's way too confident that he understands what the questions to ask him. But he does say that it was a small loss. It would 1% to 2% of my capital. And Charlie keeps saying, so you're going to risk $1 billion or something like that. I mean, but if one of us had been interviewing him, we would have guided him down. But he did keep saying, oh no, it was a small loss, 1% to 2%. That's all. Now, this is the points I was trying to make earlier. He doesn't, obviously, and this is silly, but he doesn't trade a fixed universe, right? Like me. Like all CTA trend following, you need to trade a fixed universe, the same 20 markets, and then bump it up to 40, and make it the same 40 markets. And you can kick markets out. You just can't keep kicking them out and bringing them in. You can add markets. I add markets all the time, and I keep reducing my risk on the other markets. Okay. And he doesn't have a fixed CTA-like system. Like it's probably not fixed. He gets something in his head. Maybe it's charts. Maybe it's being contrarian, listening to other people, doing some maybe fundamental research. I mean, to some degree, that big British pound trade was a bet against the Bank of England being able to manipulate the currency market and keep the price of the pound within a certain limit. Okay, look, when I first started trading currencies, cross rates. So I left the Turtle program and I started Chesapeake, and we were like, let's add more markets. Okay. So I said, well, what are these currency crosses? Swiss yen, Canada yen, Aussie yen, all these different crosses. And so we would talk to these banks, and one of them said to me, oh, you don't want to trade like sterling mark or sterling Swiss, because the countries, they keep these prices within a band. And I was like, oh, watch me. I'm going to trade these things. Damn right I'm trading them. They can't keep these things in a band. No. These governments, these central banks, they have they can do it for a while, but watch me. I'm going to trade these things. And I think that was his attitude as well. Oh, they can't keep this thing going. And maybe he had more sophisticated, better reasonings than what I'm expressing. But okay, yeah. But another thing I like about him, I don't like those two ideas as much, as I'm not going to do that. I think this ad hoc application of trend following principles kind of on an inconsistent basis is not something that I would, it sounds and seems so enticing. Oh, I just do this. I create these type of trades with these big payoffs. All right. I mean, I want a systematic, rule-based trend following system with a fixed universe and all of these rules that really keeps me on the right track. And yes, I do get jealous when I hear anyone making money in a certain way that's not the way I do it, or making more money than me, another CTA, right? So I really don't like negative relative performance. But I don't know. I think that he's not getting lucky, let's say. And I'm just saying it's not for me. I kind of know better, and I'm putting myself in a better chance of Jerry Parker making money by following these restrictive rules that big guys like Soros and Druckenmiller seemingly are not subjecting them things to. They have so much more creativity and fun and finding things. However, they take small losses and they go with the trend and they pay attention to price, and you can't predict. Okay, so I'm not going to really be too upset in change, but I do find it kind of funny that the biggest managers in the world, the most successful traders in the world, Buffett, Soros, Druckenmiller, all of these big macro guys that I thoroughly love, not a peep about vol management, correlation management. This is the silliest stuff in the world. And it's just something that CTAs have created for managed futures. And let's let them live in that little world. I used to be so anti-managed futures. Like, stop saying that word. It's dumb. It's CTA trend following. No, now I'm like the opposite. Oh, yeah. It's not classic versus new trend following. It's trend following versus managed futures. Managed futures has its own thing going on. It's got some trend following. They say they do, but it's certainly not trend following. And it's their own little thing that they have, this industry, this AUM, these management fees. Go for it. It's just something that I'm so happy not to be a part of.
Isn't it interesting? Because when I was reading Soros, I looked at that pound USD trade that made his mint. And, his rationale there was that he was betting against the central banks. And that's really what trend following does. What we're saying with our philosophy is, we are betting against predictable outcomes. We are betting against other people's models. Because what we are doing is we're recognizing the inherent uncertainty that exists in the market. And we believe that if you adopt these precise models, you're limiting yourself to a much smaller sample set than the possible outcomes that a market can deliver. And really, when you fundamentally look at what Soros does, what Warren Buffett does. Warren Buffett looks at the price. He's a deep value investor. He looks at the price that a particular stock is trading at, and he determines whether the mass participants have got it wrong. In other words, whether their models are wrong and it should be valued at this level. Soros does a similar thing, betting against the central banks. We do a similar thing in following price because we are participating in trends. We're buying higher into trends or selling lower into trends when other people's models are saying, well, historically, it's reverted back at this point in time. So we're going to rely on our history as a gauge. And therefore, their models have these threshold constraints applied around them, which means that their models only work when the price operates within their model's constraints. We don't have those constraints because we have design solutions in our models that cut losses short and simply let profits run. So where these people with this model dependency, they are becoming regime dependent or data dependent or backtest dependent. And that we are betting against their models. We're saying that that's going to fail over the long term because the future is going to be different to the past. And we've got a much more robust solution that looks at all possible scenarios. And whilst we can never guarantee that we'll never come undone, we're certainly much more robust than alternative methods. And I often talk about how trend following is the best solution of all because when people say, well, Soros was just lucky or Warren Buffett was just lucky, that might be correct. But we turn luck into a process by being in the right place and being in the right time. And to do that, to be in the right place, you've got to diversify widely so you can participate in that place. And being in the right time means you need to be systematic with a 24/7 model that is operating at all times. It might not be active, but it's ready to pounce on any opportunity. When the signal says buy the trade, you buy the trade. So, there's so many similarities, but I think our method is superior.
And I think I want to say that at least I understand. I have found for me personally that I love, that I understand how it works, at least in enough level for be profitable for many years. And I think that, of course, and I have told this before, that I have chosen my way and I love what I'm doing. So I don't, I'm open-minded, but I don't seek something outbox maybe. I want to be fully involved in trend following processes and nothing else. And I decided that for me, only this. And of course, there are a lot of different methodologies, but I don't know how to do the same, and I don't even want to know how to do the same because I have such a brilliant methodology like a trend following.
Yeah, that was really good, Rich. It reminded me of Wayne. I'll read one of Wayne's quotes. Amazon is good at recommending the next song for us. AI works in those environments. In dynamic, nonlinear environments, AI breaks down because things change in ways that have never been seen before. Empiricism versus the nonlinearity of the world. And so, Wayne is a little bit, he's really smart and he knows how to explain things and he's great with quotes. I highly recommend you listen to this Mutiny Funds podcast with Wayne. It's pretty special. He's always great and he trades options, but there's a bit of option replication going on with trend following.
Richard, I was listening to what you said about how trend following goes. against central banks and against the common knowledge. And I think that that's right, especially on the very, very philosophical end of things, because that's when it's super robust, because it gets it takes care of all your biases. But isn't it true also that it also fails with the trend, fails with the group? I mean, if you are trading equities using trend following for the last years, or fixed income, you are going with the central banks, and that was okay. And I'm saying this because many times I was discussing with people who says the issue with trend following is that it's good for crisis, and it's not good for normal markets, normal in the sense of economical normal markets. And I think that that's not the case, but I think that that's how sometimes it's seen. And I think that sometimes, trend following goes full, and that's it's one part of the equation, maybe a smaller part than what it earns on crisis, but still.
I think that, of course, it's not the case, because we have seen a lot of evidence, and it's enough to look on the charts. We have seen a lot of evidence when trend following worked perfectly well without any crisis. And maybe, as I remember, 2014, there was no crisis, and trend following worked well, and a lot of evidence of this.
Yeah, look, I personally think we're not dependent on crisis, but gee, we do well usually in certain types of crisis. However, we are dependent on major price moves. With these outliers, that's what we're targeting. So I do believe we are a bit different to a lot of other trend followers, because when you look at that market distribution of returns, I think the times that our trend following models are active are specific times when trends get material in nature. We're not participating in every trending price move, but we are participating when those price moves get extreme. Now, that extremity is when other traders who are getting the benefit of trends. So a mean reverter gets a benefit of trends. They're getting the benefit of the counter trend towards the equilibrium. All traders who are trying to get an edge, apart from option traders that might sell options, are actually looking for trends. But a classic trend follower is looking for a material trend, something significant, something where the general participant thinks that's overextended. That's where our models suddenly become active. We go still in that same direction. So, central banks have been creating this environment where it gets to a level of extremity, and we say, well, let's keep on going with that extreme direction by following price. Other people are assuming with a predictive stance that it's got to be overbought or oversold, and so they're prepared to counter trend that move. Now, those type of traders are trading what I call the bulk of the distribution of returns, which is towards the peak or the equilibrium of that regime. That's why mean reversion works well around an equilibrium when markets are fairly stable. However, because we're participating in these extreme material moves, there's a good chance that we are on the verge of chaos where things suddenly get extreme. And Nassim Taleb put a very interesting tweet up, which I did retweet, which said, when you enter large drawdowns and when you enter periods of large volatility, there is no information in price. Now, a lot of people would regard that as a really strange statement, but when you break it down, it's exactly what we are after. We don't want information in price. If we have information in price, we'll be using convergent models to extract that information and do a particular sort of trading technique. All we want is an asymmetrical system that has a constraint to minimize the loss, keep the loss linear, and leave the profit open-ended, because there is no information in the extremes of price. There is no mean, there is no median. When you get to the Cauchy distribution, the tails of that distribution, there is no information statistically that we can generate that's going to help our cause. That's why I believe that volatility targeting is a myth, And I believe that it's a symptom associated with people thinking that, well, trading what I call the bulk of the distribution of returns, thinking that there's certain information above and beyond what price, when it starts getting into this region of chaos, is telling you. And I believe when you do get into that region of chaos, there is no information. You need a system, an asymmetrical system that allows open-end potential, because price could do anything.
Well, also, I think vol management is primarily used to take profits and raise money, raise AUM, and keep clients more happy. But it's also, even if there were no clients, the traders who use it wouldn't give it up. It's redefining risk. They all know better, but it's just something that they need to do. And I would also just say, in response to Mentor, is that you can't. Sometimes it's not this. Managed futures and CTAs are not the same as trend following. So you need to. That's two separate comparisons. So the fact of the matter is that if you're using vol management and correlation management, you're not hunting outliers. You're if it gets to be too much of an outlier, you get out of some of the trade. The response can be, I'm still in the trade. I'm still in the outlier. Yeah, you're in the outlier. You're just not making the outlier money. Well, vol's picked up, correlation's picked up. It's too risky now. And it's get back and forth, that same argument where, well, we think risking 50 basis points is the risk, and the risk is not in the open trade, blah, blah, blah. So they don't buy that as well. So, but it's managed futures does things one way, and trend following is something different. And they're getting more and more different all the time. Adding a few stocks or adding, material amount of stocks to your currencies, commodities, and interest rates will more likely turn your portfolio into a more perfect portfolio rather than this goofball marketing idea that you should be some sort of crisis alpha, or we can make money in those stock trends that as long as we trade those stocks. But if we don't trade those stocks and we only trade indexes, and we don't trade that many of them, and we position our business as some sort of crisis alpha, give me 5%, please, and put me in the portfolio, 5%? Yeah, okay, so there's another problem with being crisis alpha.
I think that it's a very big benefit for trend followers, that the trend followers not only survive in the crises, but they have profit in the crises. And as it's a very important benefit, because as I remember, Joseph Felder said that when crisis occurs, a person loses his job. Maybe he can't pay his rent for a house, and also he has this in buy and hold strategies. For example, he has a very big drawdown here, and on the other different strategies. And trend following gives us the opportunity to have benefit, to have profit in crisis environment, and also trend following works in non-crisis environment.
Yeah, when I look at the trend following history, and I look at 2014, that was actually an oil crisis. It wasn't an equity crisis, it was an oil crisis, and the trend followers did extremely well. 2008, that was an equity crisis. We did really well there. But we're uncorrelated to equities. So, sometimes we'll do really well, sometimes we won't. But generally, trend following, I think, does operate within crisis environments, but it doesn't need to be specific to equities. It could be to commodities. It could be to and when we talk about a crisis, we're talking about the ability to give extreme price moves. These extreme price moves are far greater than what we ever anticipate. That's our outlier. They can't be predicted, but they're always far greater than we ever estimate. we target those things. And that is a crisis to any trader who is on the wrong side of those material price moves. That is a crisis to them. They get wiped out. We blossom.
So we were talking about adding stocks, and I believe that's a very exciting part of what we are doing at the moment as part of the portfolio construction. In the past, it was pretty, I would say, not easier, but maybe simpler, because there's only so many commodities or bonds or interest rates or forex marks available. So you can actually form your portfolio, your trend following portfolio, tiny bit much more easier. But now you're dealing with thousands of stocks out there, and your objective is still to be able to catch those outliers. So really, you need a methodology to decide which stocks you're going to incorporate. Are you going to start incorporating only the big names, the large caps? Are you going to incorporate any medium caps? Are you going to incorporate any small caps? Are you going to incorporate any growth stocks? And how much allocation you're going to make to those stocks? So, and with that thing in mind, we might perhaps see differences in the performance going forward, if traders would continue to incorporate stocks, because it will be different for different people how much allocating to which stocks. But I definitely, in my back test, adding stocks are adding a lot of value. So I'm definitely on that camp. In terms of trading trend following, I mean, the performance needs to be, performance of a market is going to super extend itself, and it's going to be outliers. But I always thought that it is not easy to trade a trend following system. So in my humble opinion, it needs to fit the personality. So if it is not going to fit into your personality to trade something else, you're possibly going to go against a central bank at times, or maybe another bank at another times, where you will be cutting your losses short and riding those winners. I don't think that is going to be everyone else's cup of tea, so to speak. But otherwise, it's definitely a very good model if you can stomach those drawdowns, and you can hunt those outliers down. Thank you.
I want to read another Wayne quote. Really like this one, and this has been something I've learned over the years as well. Wayne and I have vastly different paths, but we've come across some of the same general ideas. So Wayne says, you want to look more broadly rather than more granularly, and that's true in any statistic. The more you try to fine-tune your model with more variables or parameters, the more it's subject to be overfit, because you create noise with more precision. Yeah, I had not heard that last part before. You create noise with more precision. That's pretty interesting. I have, I'll try to work this thing I learned. I have learned that when I did my back testing, that what the computer liked was a more general rule versus a very precise rule. Like the more general and unsophisticated I could make the rule, the more it liked it. It did better. Maybe it's the loose pants. It captured more. I'm not really sure, but I really like this idea that to be overfit, because you create more noise with precision. You must have a thought on that, Rich.
Yeah, I do, Jerry. So I've actually done tests on this. So when you look at a market data series, whilst it appears to have trends, they are not there is not necessarily what we call serial correlation in that data. We can get random trends constructed by simply how we can put price data together, which means that a random trend is something that doesn't have any endurance into the future. It means that it'll visually look like a trend which you might participate in, And then you'll find as soon as you get onto it, it flatlines or goes the other way or whatever. It's totally random, the outcome that occurs from the time of entry. Our particular approach is focusing on what we call material trends. So in other words, we are waiting until the trends become so significant that there is a better probability or a better chance that there is some serial correlation or autocorrelation in that data, which is driving the momentum of that directional impulse, long or short. Now, what Wayne's saying is that if, for instance, you do a backtesting exercise against historical data, and that historical data will have clusters of serial correlation in it, and will have clusters of randomness in it. Being efficient markets, there's a lot of noise in those efficient markets. But the more you optimize and the more you add parameters to your system, the more you're going to be targeting those random elements of that market data series, which is noise, as opposed to the serial correlation elements of that data series, which is the thing you want to target. Now, it's very difficult to be able to visually see this in the data, but you certainly, in hindsight, can use Hurst regression and these sort of things to identify what segments of that data had autocorrelation in it. Was it positive autocorrelation? Was it negative autocorrelation, etc.? That's a hindsight thing you can do statistically. But when you're on the fly trading, you've got to use more simplistic visualized methods. In other words, we use a breakout technique with a long look back, which means a price has got to do something significant to get to that breakout, which means it is more material in nature than another trend that is smaller and hasn't reached that breakout that we're not interested in. That's how we selectively, therefore, participate in things that have a greater probability of having autocorrelation in it, as opposed to noise. But the more you precisely define your system, the more it's going to catch that noise, which has no enduring potential, and you're going to find the strategy falls off the cliff because it's been over optimized or data fit to that noise in the data series.
I just wanted to mention that so I'm a coder, so I code things. And I always think that there's a lot of benefit if you're a new trader like myself, that there's an extra benefit to be able to actually trade what you code so that you actually see what is happening within those thousands of lines of code there. Jerry Parker was talking about the fact that at this stage in his career, obviously, after 40 years, he has a coder, he has a mathematician, etc., etc. But if you're not coming a background like that, I'm just an average Joe who decided to trade trends, and so the question is, how are you going to do that? Okay, so you're going to code this thing, so you need a backtest. All right, so if you're able to actually know how to code it, then you can investigate different ideas, and out of those ideas has come up with the idea of trading hourly bars. So in this group, not many traders prefer to backtest on hourly bars, but you can only do that if you're constructing your backtest yourself, and then you keep the philosophy of trend following, and then you start to play with it. It takes a little bit time to learn coding, but I would say there is we always say that diversification is only the single free lunch. Actually, there's a saying like that, but I would add to that and say coding is the second free lunch, and especially if you're a new starter, there's a huge advantage to be able to trade what you code. Thank you.
I like this other quote from Wayne. Yeah, this is pretty good. With a right skew instrument, if you can manage tightly the way down, you can be wrong 99 times, and the 100th time pays for those 99. If you can manage not to lose too much, it doesn't take much of being right that nth time to make it all back and more. So that probably fits with options much more than a trend following with 40% win rate, 60% losing trades. We don't want to be wrong 99 out of 100. But it does sort of, I just remember when I was 25 years old, and learning about trend following for the first time, I thought this is just amazing. Here's the question. Will these big winners pay for the little losses. And that's the problem, is that I'm not, it's difficult as a human to be long-term thinking like, well, just pay attention to the next 1,000 trades or next 100 trades. No, I'm very interested in today's trade. I've got clients. I personally don't want to give back too much. And this is basically this formula that's available to everyone. This idea of taking these losses and waiting and thinking, well, I think I will get this outlier. And you're like, what? Why would you think that? It's only happened in the past. It doesn't mean anything for the future. Granted, yes. And so we're always thankful and always surprised when we finally do get these outliers. And I think in some ways I have a big advantage in that I know nothing else. And every year I have another year behind me of it kind of working out. And there's a couple of other problems with my psyche that prevents me from doing anything else. But, oh yeah, that's pretty good. And then he goes on, the behavior of humans tends to be the same. You can trust human behavior to be repeatable because people are always the same. What we can model of human behavior, we can rely on. We do our best to try to extract what's behavioral versus what is just noise. And this is the way I was taught as well. Do the hard thing, do the right thing, buy the highs, sell the lows, take small losses, let big profits turn into small profits, let profits turn into losses. Oh yeah, I always chuckle when I see, well, when this happens and that happens, I move my stop up to break even. I think that's pretty funny and silly. And yeah, but anyways, I think both of those ideas, are pretty great.
Yeah, I love those Wayne statements. It reminded me of the Dead Poets Society, where Robin Williams is taking his students to see the photos of people from 2 centuries ago, the students of 2 centuries ago, and sort of just stating the obvious, that those people were you 200 years ago. They had the same hopes, the same aspirations, the same fears. All of these things are consistent in human behavior. And that doesn't change. And that's what drives trends, because it's the human mind that actually drives the trading decision to buy or sell. Ultimately, whether it's through a model which has been devised by a human mind, or whether it's a discretionary trader who is trading with the human mind, it is human behavior ultimately that drives all of these decisions. And, that is consistent, and that's what creates these trends. So, yeah, I thought that was a great statement from Wayne.
And sorry, I think that's a huge issue, because many people who don't like trend following, they don't like it because they don't see how it fits on the below the behavioral biases side of humanity. They say this doesn't fit on a macroeconomic or economic sense. It doesn't fit with the discounted cash flow theory, and it's hard to, it's not easy to me to understand. And plus, if you are using futures and if you're using leverage, it started to sound to me as something that I could not stomach, so to speak, because it's very hard for somebody to agree on what we are agreeing, that you can ride human emotions in a systematic way.
Yeah, I think having systems with these negative characteristics, counterintuitive characteristics, is beneficial. Now, this next quote, it reminded me of something that I think I've heard Rich say. So maybe you can unpack this for us, Rich. Empirically, we don't have a million years of data. We're using limited data. We don't know the full shape of these distributions or the true behaviors of what might be just chaotic, nonlinear environments that can't be modeled or forecasted. I have all this quantitative information in my mind. There are limited data points. We only have as much data as we have. It's only just a representation of what might be right. This feels like a pattern I've seen before, knowing at the same time that it's a small sample pattern. Yeah. So we're not able to model it, but we are using these systems. We call them systems, not models. We can't model, the potential upside and what's going to happen in these trades. We just use these rules to hang on.
Exactly, Jerry. What he's basically saying is that, when you use 30 years of history or 40 years of history, your data sample of 40 years, and yet, we've had thousands of years of human occupation on this planet. So, you can go back to the Roman civilization. Is the Roman civilization still living today? Well, no. The civilization collapsed. We've had many new civilizations, over the course of time. All of those events are possible in a future that is unlimited in potential. We don't know when they're going to occur. We're just working on a very small data set of what has occurred post-war, effectively, in possibly a boom time, which is going to be totally different to what we experience in the next 20 years, 30 years, 100 years, 200 years. No matter the sequence of events, we could get a totally different sequence of events than we've ever seen before in the last 30 years. So he's just stating what we continually say, in that our method of cutting losses short, letting profits run, not being beholden to a back test, potentially looking at scenarios that have never been seen before. How rigorous is our models in defending against loss of capital in those situations? They're the things that we are continuously stating, and it's obvious when you start looking at things from a much more granular perspective, much more wider perspective, stepping back, looking at the tulip bubble back in tulip mania times, going back to Rome, all of these different civilizations. The US 500, the S&P 500 is only really representative of an economy in a post-World War boom, predominantly, the NASDAQ, etc. Dow Jones has got a 130-year history. If you go back over that history, you see it's had a 95% drawdown, I think it was, back in 1925. The small sample size that we use, where we see drawdowns of maybe 50% in the equity markets or the indices, we could get 95%. Who knows what we can get?
So there's a particular part of the backtest that I actually don't like to use a lot, but it is very popular and known as Monte Carlo simulations. So maybe some traders are very concerned about what are the possibilities, so they would like to have these 10,000 plus runs and to be able to simulate their equity curves and estimate the risk of ruin of their portfolio. I've never spend a lot of time on Monte Carlo. I calculate it, but it's just, I always find it a little unrealistic, but it surely captures those possibilities that might happen. It's just another tool, I believe, out there, even though I've never thought that it's a very useful tool. Thank you.
Yes, I find Monte Carlos a pretty well useless for our trend following. So in other words, when you look at a real data series and you trade a trend following model on a real data series, you find that there is this inherent edge in that real data series. But when you trade that trend following model on a random data series, you find that all of your trend following models fail. So on Monte Carlo test, what that does is it breaks up any serial correlation through the randomization method that is in that natural actual data series. So it's always giving you a random sort of outcome as opposed to a realistic outcome. The same as walk forward tests. Walk forward tests work on the principle that if you break up your data series into quartiles, or however many times you break them up, you want to have consistent performance in each of those quartiles, and particularly an out of sample. Which is a furphy in relation to trend following speak, because we know that trends are not distributed across the market data at equal intervals. So there are periods of time we've got to enjoy stagnation, or we've got to enjoy drawdowns. And there are periods of times we get everything occurring in one event. So walk forward, Monte Carlo, they're useful for other methods, but certainly not useful for trend following.
I've heard Bill Eckhart say, I think, the same thing. Like, he doesn't really understand the benefit of out of sample. Just use all the data, and optimize your parameters based upon all of the data versus a half or 2/3, and then see how it does over the next one half of data, the next 1/3. So I don't really I always try to change the subject because that's another when people bring that up or a client or something, because that's always just a given. I think in some respects that oh yeah, you've got to do this out of sample testing, but I think the turtles were pretty much told to use all the data, treat all the data the same. You can't overweight most recent data.
One thing that I liked when I started looking at trend following was that it was kind of developed in two places at the same or nearly the same time, in US and in Europe. And I thought that was kind of a good thing, a robust characteristic.
Well, yeah, I don't know about that. I'm not sure who gets credit for trend following. I think crude trend following, probably similar to what I do, has been around for a long time. I think I don't want to be too biased and negative here, but I think let's say that certainly before the turtles, right? Because it wasn't like Rich and Bill came up with these ideas in 1983, So probably Rich supposedly made 200 million. And so I think that the the general Rich was a big math. Rich is super smart in math, and then Bill is I think almost a PhD in math. So when they got together, they had to put together these rules, and they probably were very good at creating the money management framework, ATR, and some of these broad rules and principles that I speak about. Then at this similar period, let's say the Europeans are doing similar things, but with a different emphasis of, more they probably came at it from a different background of math and investments and traditional ways of measuring performance, and then overlay trend on top of that, but then preserving some of the more sharp ideas and vol is a problem and things like that. And I think those two strands still exist. One, I think, is more trend following, and one is more, well, we're not going to give up what we learned in our big schools and our PhD programs, but we're going to combine the two. And I think the U.S. version was starting from ground zero with nothing in making trend and proper trend following without regard to sharp ratios and volatility. That was going to be the bottom line. And so I don't know if that's a fair representation, but I mean, who really knows and who really cares? Honestly, certainly there's the managed futures way of doing trend following is very prevalent and dominates the U.S. CTAs as well. So there's really no difference there. But I mean, I don't know. I get upset because, some of the European CTAs over the years have criticized and belittled the turtle training as simplistic and not very smart and old-fashioned and won't work. And we came along and took it to another level where I think that's just total bullshit.
No, I know. I mean, I don't care also about who started it, but the underlying systems of how to trade are quite similar. In cut your losses short, let your profits run, diversification, leverage, etc., etc. And the fact that it was kind of tested, so to speak, in two different places with different kinds of people, that part. I agree with you with the volatility control part and how to manage the assets under management thing. But if you just see the trade, the way they trade, and the fact that they both did it on two different places at kind of different times, I think it makes it more robust.
I'm more impressed with Rich and me. He did it in Australia. I did it in the US. Yeah, I'm joking.
I'm laughing now.
One of my goals in life is to get that tweet from Rich that I just spilled my coffee. Oh, yeah, I did it this week with dumb money. So anyways, yeah, it's definitely one of my goals in life is Spaces doesn't lend itself to my humor because when I mute my mic and someone says something, I start laughing. And I know all of y'all are laughing at some of my jokes as well, but out of courtesy, we mute our mics. All right, I'm going to call it a day unless someone wants to take over for the next few minutes and make some comments or ask a question. And I'll give you a couple seconds to ask your question or make a comment.
Just want to say thank you. Thank you very well.
Yeah, me too. Thanks everybody for being here. It's been fun. It's very good. It went by a very quick 2 hours plus. I'm sorry about, I think it's a Spaces problem because so many people have just DM'd me and saying I'll have to listen to the recording. So I know we did record. We are recording, so that's good. And then listened to Rich's recording as well on his site, and I'll post that later. So it's been fun. Everybody have a good weekend, and see you next week. Thank you.
Cheers, everyone. Bye.
Thank you.